take 5 to 7 years to finish that project because, even though you can sell homes at pace, you don't want to overexpose equity to a project like that. Well, you think about leverage in business, you're leveraging as much as you can with debt. If you hired somebody who already had a decade of experience, they cost twice as much, but they show up with a playbook. What are you really hiring somebody for? It's so that you can leverage your time. Well, if you hire somebody that's too junior, you haven't leveraged anything because now you got to spend all your time teaching them.
Hey, what's going on, guys? We got another episode for you guys. We got Jack Martin as a special guest. He's going to talk to us about mobile home parks, investing, and going to tell us why it's one of the most stable assets that you can get into nowadays. So, Jack, thank you for taking the time and jumping on the podcast with us. And I'm excited to learn more about mobile home parks because I really don't know that much about them. So, if you just want to take a moment and introduce yourself to those who don't know you, and let's get started.
Yeah, Jack Martin, Scottsdale, Arizona, co-founder of a company called 5210, and that's number 52, and then TEN is spelled out. I'll kind of back up to the genesis of my real estate. So I was a land developer, spec home builder. I owned a construction company, actually a pair of construction companies. This is back like 20 years ago. 25 years ago now. And then, when you remember when the game Cash Flow from Robert Kiyosaki came out? So there was a bunch of buddies from our church were playing that game. And then they asked the question, why are we not playing this for real? So that kind of, started out with a handful of rental homes that we fixed up. And then it wasn't long after that, we started wholesaling. So we became one of the largest wholesalers in Arizona, did like between 200, 250 deals a year. And then I got into apartments, which I thought was going to be my final resting place in real estate until I tripped over a mobile home park. So kind of feel like I fell into this serendipitously. But, a lot of experience in land development, single family, condos. We did an office building. We did a lot of kind of one-off commercial real estate, did a bunch of apartments, in the range from little fourplexes all the way up to 120 units. And then we, most of those were syndicated. So in the latter part of that business, we were partnering with investors, pooling funds, buying them, repositioning them, and then exiting. And then I got into mobile home parks and I discovered, I thought they were just going to be the same thing. 100 people living on the same piece of dirt. But it turns out they're quite a bit different, and we'll get into that as we go on today.
So you have pretty, I won't say the typical, but a lot of people who are real estate investors in general, they start, wholesaling, or they start flipping houses, and then they get into multifamily. Curious as to why multifamily wasn't your final resting place.
Well, I thought it was going to be, but there's this little park that I bought up in Flagstaff, Arizona. So I was trying to buy the apartment building next door. It had been vacant. The city said you can't bring it back online because you don't have enough land for parking. So right next door is this little mobile home park on a half acre. So I bought that, went back to the city and said, okay, now I have my land, and they still wouldn't let me bring it back online. So long story short, I didn't even get to do the apartment, but now I own this mobile home park. And in a short period of time, we repositioned it, changed all the utility metering and cleaned it up and increased the rent. And then we just put a third-party manager on it and let it run. And it was the most stable cash flow of anything I ever owned. There was no turnover. We owned it for about 3 years. No drama. Everybody paid their rent on time. It was the easiest and most steady cash flow I had ever had in my life. So that's when I decided, it's time to take a really hard look at this asset class. And then what I discovered, which was really powerful, when you look at the performance of real estate through the GFC, so back 2008, 9, 10, 11, that stretch where everything was just coming down. It was a foreclosure on every corner. Even really good operators of apartments that were conservative with their debt. They had good management practices. Many of those still lost their properties to the lender. And it wasn't because of their mismanagement or aggression. It was because when things get difficult, people will seek affordability. So you have tenants that are in your apartment moving out to another place where it's cheaper. And then the only way that you can fill up your occupancy is to lower the rent. And now your income is not, or your NOI is not covering the debt service, or at least not the DSCR ratios that are required for a refinance. Now you get to the end of your commercial or get to your maturity date on your commercial loan, and you can't get refinanced. So that stuff was happening in 2000, 10, 11, 12. And it wasn't because of mismanagement. It was because we were in a recession. Things were difficult. Great managers still got in trouble. But when we looked around at all the real estate asset classes, because that was happening with office and it was happening with industrial, it was happening everywhere. When you looked at mobile home parks, I couldn't find a single foreclosure. So I was looking for opportunity, but what I discovered was stability. So then you dive into the why. So how much do you guys know about mobile home parks?
I know a little bit. I've done
Not
some brokerage. So yeah, I know a little bit about them.
Okay.
Yeah, not a ton. I mean, really what my mentor had told me about them was that, you have a lot of cash, paying rent people that, they pay on time all the time because it's only like pad rents are like $750, something like that. Just depends on if it's, park owned homes or not. And they're very stable. That's like pretty much like what you're saying. I mean, that's industry wide. I mean, it's not like, the foreclosure thing. Like I hadn't heard that before. That's interesting, but that's pretty much all I know.
Well, for your benefit of your audience, the simplest way to describe a mobile home park, because they are really unique compared to most real estate, is if you can imagine a giant parking lot, but instead of parking cars in each space, you park a home in each space. So, but the tenants own the homes. I mean, they don't actually drive up and park their home, but the way that you fill up a mobile home park is, as the owner, I buy homes and I put them on the space and I set them up and then I put them for sale. But when the transaction occurs, the buyer comes and purchases the home with chattel financing from a third party usually, and then they pay me the rent for the space. So as long as their home is sitting on that space, they pay me what's called lot rent. They pay their own utilities. And then as the park owner, we take care of the common amenities, the streets, the lighting, landscaping, clubhouse, pool, spa, if it has all those things, right? And we're not talking about trailer parks here. We're talking about manufactured housing communities. They're like little subdivisions on one piece of property. But as the owner, I own the entire piece of property, and I get paid rent for each home that sits in a parking space on my property. The penalty for not paying the rent is the forfeiture of your home. So think of it kind of like if you parked your car in a parking lot where it was paid, and then you just never paid and you never went and picked it up. They would take your car, like they abandoned title and they would own it. So similar to that, the way that mobile home parks work, and this is nationwide, is the penalty of eviction for non-payment of rent, and that's lot rent, comes with you cannot remove your home. So like the only way you could remove it is if you caught up on all the rent and back payments and penalties and fees, which of course if you could have done that, you would have done that. So the point here is it's not a predatory rule. The point here is that people pay their rent. So we've been doing this for over a decade. We have almost 1,700 lots right now. We've only had that happen one time. And it wasn't because somebody was upset and they didn't pay their rent. It was because somebody passed away and the kids didn't want the home. So they weren't going to pay the rent on a lot rent for a home that they didn't want. And it was an older home that was probably worth, $15,000 or something. But I think that the point here is, like during COVID, if you can go back to COVID, if you owned apartments, and I got a whole bunch of buddies that do, there was strategic default going on. So when there was a moratorium on evictions, meaning you can't evict someone during COVID for the non-payment of rent, tenants would say, well, I don't have to pay the rent. Well, then why would I? And they'll buy a TV instead or whatever, right? And then when the moratorium gets lifted, then they get evicted, but they knew that. They were getting 8 or 10 months of free rent. So it was a strategic thing. In the mobile home park business, during that same stretch, we collected 100% of our lot rent, all of it.
Wow.
So and even though there was a handful of people that did have, they got COVID or they had some kind of issue with COVID, we worked with them, made sure that we helped them solve for that and put it on the back end or make some deferred payments so they could catch up. But we're still able to catch up on all the rent. And it's because it's super inexpensive. So from a cost of living perspective, if you own a home in a mobile home park, you're probably half of what it would cost to live in an apartment or less. So it's really inexpensive.
Yeah. Another point too, kind of a mentor of mine who was talking to me about real estate investing early on made a point, which is kind of similar, where if you look at residential real estate investing and you buy a $500,000, $600,000, $700,000 house and you're trying to rent that out, if the economy goes south, then that person is going to now move down in quality of housing. So like if it's a $500,000-$600,000 house, they're going to probably move into a $300,000 or $400,000 house, and then like so on and so forth. So like somebody in a $300,000 house is probably going to try to move down. But if you're in a manufactured home, that is like the bottom in terms of pricing. So like it's very cheap and it's very affordable. So like you said, those people have not necessarily, like you said, it's not predatory, but they have no other option. It's their cheapest bet. So you're not necessarily, I guess it's kind of like recession proof almost, because those people aren't going anywhere. And even if they did for some reason, you have the people in the classes above it, in the higher, like nicer houses or whatever you want to call it, now would probably be looking to move into something like that.
Yeah, absolutely. Yeah, I kind of look at it from when things are really good economically, rent gets expensive, prices of homes go up, everything gets expensive. So it's like it's the affordable option in an expensive economy. And then when things get difficult, just like you said, people's existing housing solution becomes unaffordable to them. And then they're looking for something that they can move down to in monthly expense. So what's interesting, though, when I would have never guessed, guys, I'm in my early 50s. I used to drive by mobile home parks every single day going to school as a kid. And I'm pretty grateful that I wasn't living in a mobile home park, that I was living in a regular house. And I looked at it as trailer parks. So that prototypical stereotype that you think of about a mobile home park, I certainly held that. Even when I purchased that first one, I was purchasing it so that I could turning it into a parking lot. And then I discovered the power of these. So they may not look pretty on the outside, but if you look at the cash flow and the P&L, it's very pretty in there. But there's something else that I discovered as I went to my first couple parks. They were prototypical mobile home parks. So the early parks that we bought, I wouldn't buy those today. There's some very high quality mobile home parks out there, and there's a synonymous term: trailer park, mobile home park, manufactured housing community. It's all the same thing, right? But actual manufactured housing communities, they're like cute little subdivisions, gated with amenities. They're really nice. And some of these manufactured homes, they're essentially built just like a regular stick-built home, except they're moved in on a frame and then they're skirted. 2x6 walls, regular insulation, drywall, granite countertops, stainless appliances, regular toilets. Like, they're not the way they used to build them in the old days, and these are the actual trailers. Everything was lightweight, everything was small, the walls were this thin. If you go to remodel an old vintage, like 60s vintage mobile home, like, you can't go to Home Depot and get parts. None of it will fit. You have to actually go to a specific mobile home supply store to get the parts, because everything was designed to be lighter and smaller and thinner and whatnot. So, but that's not the case today. You see a new, double wide mobile home going down the highway, in two different separate trucks, and you can kind of see in the inside. Looks just like a normal home. So these manufactured housing communities can be really nice.
Yeah, I'm curious, because that's something I was thinking. When you hear a mobile home park, you think of kind of more like trailer park. You have kind of there's like a stigma that you have in your head of what it looks like. Definitely don't. The first thing that pops in my head is not a nice maintained neighborhood. If you think about that, I think about like Florida or something. But I'm curious. I've done some brokerage, like I mentioned, and the people who I worked with were really particular in their, like, what they were looking for, what they would be willing to accept, and what they'd buy. So I'm curious what your buy box is and what you'd recommend for somebody just starting out. And kind of what I mean by that is I got a lot of instruction like, okay, we're only buying parks that are on city water and sewer. We won't touch anything that's well and septic, or we only buy parks that are tenant-owned homes, no park-owned homes, and stuff like that. So I'm curious, like, what your buy box is, and then also, secondly, what you recommend for somebody just starting out. What kind of park should they go after?
And then we can kind of dive into the whys behind some of those things as well. But generally, the creme de la creme is 100 spaces or more in a good quality market where median home values are, $300,000 or greater. Lot rent across the market is going to be, $600 or more. All tenant-owned and city water, city sewer. That is the creme de la creme. Paved streets, sidewalks, or at least curbs and gutters, some amenities, 3-star quality or greater. Now let's unpack the whys behind some of that stuff. That's probably, in most markets, that's a $10 million park or greater. So it's kind of a threshold for us too. Like, we really don't want to deploy capital unless we're purchasing something in that 10 million range or greater. And that's, when you grow your business to a certain size, even though the numbers might work on an inexpensive deal, you have to ask yourself if it's worth it to deploy your team. I mean, I see deals every day that are great deals, but they're too small for me. So, and I can't, it takes the same amount of energy to run a $1 million asset as it does to run a $10 million asset. So for the cost of really quality staff members, you have to allocate their time to the right kind of properties. So that's kind of a little side bit there. Tenant owned versus park owned. The goal for the reason why you want tenant owned homes is because of the fact that they have ownership. So there's a huge difference between the mindset of a resident who's renting and a resident who owns. So if you think about that apartment tenant, for example, all it takes is a new girlfriend on the other side of town and they're out of there the next weekend. They're gone. There's nothing that holds them back except for their deposit, right? And it's a couple buddies in a pickup truck and they've moved. The barrier to exit in a mobile home park is the sale of your home. So there's a lot of contemplation that takes place there. So they decide to move. They put their home for sale because moving mobile homes doesn't make any economic sense. It costs like $10,000 to move one. So it makes more sense to sell the one you're in and then wherever you go, buy another one in a new park over there. But what the point of this is, it's not a decision that's made on a whim. It's something that is deeply considered. Well, the same thing occurs when they're buying. So if you're choosing an apartment, you're like, okay, I got a job right here. There's an apartment right there. That's knock on the office door and say, do you have any vacancy? That makes great sense. You could do that on a whim. But when you're purchasing a home in a community, you're looking at homes just like a homeowner would go, or just like you would go look at homes with a realtor in a neighborhood that you moved into. You look at the park first and say, okay, I like the quality. You meet the management and you say, okay, well, I like the manager, or I like the way that they run their business. And then you look at homes in the park that are for sale and you make an offer on one and you purchase one. That's dramatically different than being a renter. So the difference between park-owned homes and tenant-owned homes, some people would suggest that you could rent that home out for $1,200 a month, and if you sell it, you're only going to get like $600 a month for the lot rent. Yeah, but that person is never leaving. You're never going to have to repair that home. Yeah, so the greatest cost in residential rental real estate is turnover. People think it's some other expense, but it's actually the opportunity cost that kills you when somebody moves out. So not only do you have no income coming in at that time, you also have to reposition the unit. That costs you money. So now you have money going out the door. And then you have to spend money marketing to find a new tenant. And then depending on where we are in the economic cycle, you may have to give incentives, 3 months free or a free TV or something on top of that just to attract the tenant. And then you immediately open yourself up to the risk of that happening again. So having been an apartment guy, and we usually only own them for about 24 months. I mean, we would buy them and reposition them while we were operating them. So like a portion of the units would get renovated and the rent would increase, and then you just kind of move yourself around the complex. Turnover was a killer. I mean, it was the most painful thing. If you have tenant-owned homes, you just flat out don't experience that. So yeah, it might happen on occasion, but the delinquency in a mobile home park that's tenant-owned is below 1%. I mean, at least in our experience, it's really, really low.
Wow.
So, and the default, like I said, it's only happened one time. Like we just, it's now maybe that percentage could be greater if you purchase parks in lesser locations of lesser quality. So I'm only speaking to kind of medium to high quality mobile home parks of size that are of good, they're in good markets, they're in good locations, and they're nice properties. So tenant behavior may be a little bit different in those kind of parks than they would be in rural Georgia or, the upper Midwest. Like, I don't know. So, but anyway, that's one side of of the tenant-owned, park-owned argument. But the other side of it is if you're going to sell it or if you're going to finance it. The best debt out there, and this is this can change, but right now, agency, that's Freddie Fannie debt, is the best debt with respect to the interest rate. So you're probably only about 150 bips over the 10-year treasury for a commercial loan on a quality mobile home park. They won't even look at lending on your park unless you have a certain percentage of tenant-owned homes, and usually it's up near 80%. So you have to be highly occupied by tenant-owned homes. They understand the stability of a mobile home park when it's filled with tenant-owned homes too.
Yeah.
So they're looking specifically to put debt on on properties where that's present. And then if you go to sell it, most of the professional buyers who really understand mobile home parks, they don't want to go through the whole tenant or park owned drama. They're just not interested in it. So now the truth is, when you buy an existing mobile home park, it comes with park owned homes. We've never purchased a park without one. Sometimes we get, like one time we got 100 park owned homes.
Wow.
So there can be a great opportunity there. You can fix those up and sell those. You could do rent to own contracts. I mean, there's a lot of opportunity if you build processes that will allow you to convert those. So I wouldn't shy away from park owned homes as long as the market will allow you to sell. So a little tidbit here, a little kind of hint. If you're trying to purchase a park where you will have all tenant-owned homes and there's a high percentage of park-owned homes, you got to ask yourself if you'll be able to sell them. Why are they park-owned in the first place? So a lot of times the reason why they're park-owned is that the owner who purchased the park thought he could fill it up and sell homes, but then he discovered he couldn't sell them, so he just rented them. So somebody else has already tried to do it, and it wasn't because they were terrible. It was because the market wouldn't allow it. So there are areas of the country and there are, lower value markets where home sales are just difficult. And typically that's going to be when you can buy a house in that, like a fixer-upper home in that same market for 150 grand, you probably can't sell mobile homes there. So that's why, we look at a little bit higher value markets it is the most important thing to us, because if we have to sell homes, we want to have there be a wide margin between the monthly payment on a stick-built home and the combination of lot rent and the monthly payment on a mobile home in our park. Like, there has to be a huge delta there so that it becomes attractable from affordability perspective.
Yeah, that makes a ton of sense. So if you're saying, you guys are not shying away, you guys are probably more often than not buying parks with park-owned trailers or manufactured homes, et cetera. How are you guys financing and getting debt on those when you're buying them? If it's difficult, are you guys doing bridge, or are you guys come with cash and then refinancing, or how are you taking down those deals then?
Yeah, so on the most broken parks that we purchase, they wouldn't even qualify for traditional debt. So really the only way to buy a really broken park, and I'll take one that we bought in Arizona about 3 years ago, 250 lots. There was only 25 tenant-owned homes. So we're talking 10% tenant-owned. That's a huge project. There were 100 park-owned homes. Half of those were rented, half were vacant. And then there was over 100 vacant spaces. I think there was 125 vacant spaces. And some of those had a scattering of like RVs. It was a great park, great location, great bones, but just neglected. Roads were terrible. Pool was closed, empty. The clubhouse was stacked full of stuff that the owner knew or owned, and it was like he just used it for storage. It was just one of those places where you walked in and you're like, holy smokes, this is bad. But it could be really nice. We put a couple $1 million into renovations first. Fix the roads, fix the clubhouse, got the pool working, kind of bring this park back to life. Renamed it because it had a terrible reputation. So all new branding and website and signage and all that kind of stuff. And then we started fixing up those vacant homes. And we did the exteriors and the roofs first. I mean, roofs are kind of important. So we did the exteriors and the roofs first so that the park looked nice. And we were taking, 80s vintage, 90s vintage parks or homes and redoing them so that to the casual eye, they look like brand new homes. Really nice. There were a handful of tenant-owned homes that still look terrible, and we fixed those up too. We just decided, you know what? We're trying to establish brand here. Tremendous opportunity when you can influence what the community is going to look like and what the tenant base is going to look like. So we essentially got to re-tenant the entire park. But now we're able to raise the rent. So the market rent for that park was probably about $800, but when we bought it, it was at $500. So new tenants are coming in at $800, and we started selling those homes. We sold, I think, almost 50 homes in a year there because they were inexpensive. And we still own that. We're on year 3. I think there's probably still 85 spaces vacant that we use for new homes that we bring in, about 10 at a time, and some rolling RV stock. But you wouldn't even recognize that park now. It's single wide and double wide, brand new and fully remodeled, kind of older vintage homes. It looks like it was built 5 years ago. It's so nice. And now we're gating it too. Like the last part of that project is gating it. But to back go back to your question, a project of that nature is going to require a lot of cash. There's just a ton of work to do there, but cash for the capital improvements, but also for the inventory of homes and the renovation of homes. So you couldn't get a loan on that unless you get it from the seller. So that particular seller, I had met with him for coffee for probably 5 years. And he always told me, I'm not a seller, Jack. I'm giving this to my boy. And this is kind of classic, as you guys, I can see Graham's smiling. Yeah. And then one day he said, yeah, my boy told me he doesn't want it. Yeah. He wants to live in Hawaii and become a surfer.
That sounds awesome.
Yeah. So I was like, okay, well, I'll still buy it. He said, well, if you'll give me a premium, I'll sell it to you. Because I know if I fixed it up, I would get this premium. I said, well, I'll give you that premium if you carry the paper. So we put, that deal it was a $22 million purchase. We put $4 million down, and he carried $18 million at 3% interest only for a decade.
Oh, wow.
That's insane.
Yes. So that deal works. Like, we probably paid going in, sub 3 cap, which sounds crazy, but going in cap rate is not the metric that matters. It's correct. What you can make out of the property. I mean, the income was about $800,000, and that was a little bit. That was him sharpening his pencil, saying it was $800,000 on paper. But that property has the potential to crank out $2.5 million in NOI. Wow, that's why you buy that park, right? Yeah. Now it'll take 5 to 7 years to finish that project because even though you can sell homes at pace, you don't want to overexpose equity to a project like that. Yeah. So it makes more sense to buy just enough brand new homes. As you sell them, you can order new ones and just keep rolling that inventory, and then balancing that with some RV income that is temporary or seasonal, while you're filling up permanently filling up spaces. So it takes a long time, but those are the ones that on the back end it'll have the biggest number.
Yeah.
So on the other end of the Go ahead.
Oh, I was just going to say that ties into something I was going to touch back on. You're talking about seller financing, which I've heard a lot of people say, like with storage and boutique hotels and mobile home parks, that seller financing is a lot more readily available by these sellers because either they're one kind of used to it, maybe they acquired these properties on seller financing, or two, it's kind of maybe it's harder to get bank financing for whatever reason. But so seller financing seems like a good option. One thing I was going to ask you when you're talking about the Freddie and Fannie, is it like multifamily where is there a balloon or is it like fully amortized, or kind of walk us through what a typical term would look like in a mobile home park if you did go the traditional financing route?
Yeah, commercial debt is available for mobile home parks in the same way that it is for all other commercial real estate. So you can get it from banks, credit unions, CMBS, Freddie, Fannie, life companies. I mean, there's a lot of options for debt in mobile home parks, but a lot of it has to do with the quality and size of the park, and it has to do with the experience of the operator. So if it was my first park and I'm buying a 20-unit mobile home park, my only option is a bank. And it probably needs to be a local bank. And you probably should have a relationship with them, like deposit relationship. That's probably your only option other than seller financing. But if you're buying, a 50-space park or larger, and it has paved streets, it opens the door to a pretty wide audience of debt. Typically, you're going to get, somewhere in the neighborhood of 65 to 70%. There's times when the market's good where it'll be higher than that. Interest rates right now would range from, mid fives up to, 7 for kind of traditional product, or probably like high sixes. Yeah, probably 7. Right now, if you went to get a bank loan, it would probably be around 7. The spreads are higher. They're not backed by the federal government, of course, right? But there's a lot more debt options than most people would think. So if you have a ton of experience, there's more options available to you. But yeah, when you're first getting started out, you can get a loan from a bank. I mean, we did our very first sizable mobile home park. It was a $2 million deal, and we got a local bank loan from the bank that was literally like 5 blocks away from the property. And we just walked in and knocked on their door and said, I heard you do mobile home park lending. And, we only had done a couple deals in our past. Our track record on mobile home parks was literally like less than 200 spaces. So
wow.
Something I wanted to ask was, because what I'm hearing is if you don't own the homes and you're just renting out the lots, the pads, and the tenants are paying utilities, essentially you have a triple net lease with all of these tenants, and you don't have to worry about maintenance on the home. You're not worried about toilets. You're essentially worried about managing the property, and that's kind of it. I mean, is that Is that the reality? And how
Um,
intensive is the management?
Yeah, so it's a great question because in let's go back to the comparison between apartments and mobile home parks again.
Okay.
Something I'm very familiar because I did both. There's a lot of options for third party property management in the apartment world. In most markets, you have a dozen options of that are pretty good. Like they have a lot of experience. They do multifamily property management and they can handle everything from soup to nuts. That's not true in the mobile home park world. So fully stabilized mobile home park where all the homes are owned by the tenant, all the deferred maintenance is done, there's no capital improvements to do, that you could get a third party property manager for and they could manage it pretty well. But if you're taking a broken mobile home park, and let's use the one I described, that would never work. So, and there's a reason for this. Property management companies get paid by percentage of gross rent collected. Well, think about the difference between collecting $2,000 a month per unit for an apartment or collecting $600 a month per lot for a mobile home park. And even if you have 100 lots there, like there's not a lot of income that you're collecting with respect to the management services that are needed. So most property management firms that manage mobile home parks will do, like they'll collect your rent, they'll send out notices, they'll hire and fire your manager or the on-site staff, they'll hire the vendors that do the tree trimming or the lawn mowing or whatever, and then they'll pay your bills and they'll send you a P&L or your bookkeeping. That's all they can do. That's all they can afford to do. But when you're moving homes in and out and you're renovating homes and you're selling homes, like there's so much additional variables there and nuance there that they just don't have the capacity, nor did they have the same interest that you do. So we tried it on one property and there was only like 20 lots that were vacant. And it was so painful. They would buy the wrong house or they'd make a recommendation to buy the wrong house. It would literally take a year to get one house set up and installed and they would use the wrong vendors. I mean, it's just a disaster, right? So if you have a heavy lifting, or if you have an intention to build a mobile home park portfolio, you have to build a property management company in-house. You have to pull all the levers yourself. So we started that right after our first park. We realized this is a fail. We can't move the needle. They don't have the same interest that we do to move at the speed that we know is possible. So we have our own internal property management. We oversee all of our own maintenance and construction projects. We do all of our own home sales. We have our own marketing staff in-house. Like you have to really be able to scale. You have to be able to do all that stuff yourself. So that's probably a lot of little fire hose to that question.
No, yeah,
but
no, I think that's good. That's kind of the way that I figured that question was going to go. You had your own team, and I was curious exactly how you guys built your team. Like, you guys are out of Arizona, but you own. I think this was before the podcast started, but you said you own parks in multiple different states. How did you build the team? How did you morph the team? And how are you managing, these properties in multiple different states?
Yeah, a great question. So I think that's the most difficult thing to do when you're building a business to scale is to hire really, really good staff. So particularly in the mobile home park business where the revenue is by percentage compared to other asset classes is low. So we wore a lot of hats in the beginning. In the beginning, so I have a business partner. He runs the ops. I raise the capital. I find the deals. That was kind of how it went. But we're still both wearing other hats as well. I do all the reporting. I used to do all of the distributions. I mean, there's a lot of things that have to be done to run a business, particularly when you're using third-party investor capital. So, but we just kind of started bolting on the greatest need. We'd get to a spot where we're like, okay, we can either take a raise here or we can hire somebody. I said, well, I'm tired of all this extra work and missing, my kid's birthday party. So we're hiring an accountant. So that's where we went first. We got an internal bookkeeper who had accounting experience as well. And then the next thing that happened as we grew in scale, we needed somebody to oversee our property managers. So like a regional property management person. So we hired that person. They're expensive. But each time we built our business and we had available cash flow or proceeds available to where we can allocate this to ourselves or to the business, we put it right back into the business. So I think a lot of the answer underneath the question that you asked is in the first 5 to 7 years, depending on how aggressive you are, you're going to have to tighten up your belt. Like, yeah, you're going to want to go buy a vet, but you shouldn't. You should hire a bookkeeper, right? You're going to want to go get buy a bigger house or whatever, or boat. You shouldn't. You should get a property manager, right? So we've been doing that this is our 9th year now. We have people in our company that make more than we do. They're really, really good. So you find industry professionals that have decades of experience in their specific portion of the business. And now you can hand off things to them that you never thought you could hand off. And that allows you to scale your business. So the answer to that is you got to put money back into the business.
Yeah.
Okay.
I'm going through the book. That makes a lot of sense. I'm going through the book Who Not How right now. And we were talking about how you don't look at it as a cost, you look at it as a investment, and that you're investing in people. They're not a cost, it's an investment, because you're putting money into these people, you're helping them with their career, and they're also going to help you grow and take you to the next level and give you so much time back. So I think that's a great point. And it's easy to forget that too and think, oh, like you said, I'm going to go buy a new car or whatever it may be.
Well, you think about leverage, in business, you're leveraging as much as you can with debt, conservatively but you're leaning into the use of inexpensive capital the much as you can, but you're also leveraging time. Mm-hmm. So, in the same way that you would approach a loan, I want to go get the best quality loan and loan terms that I can possibly get. You should also be hiring the best possible people that you can find. So if you're scaling and you're going to grow your business, a good rule of thumb is to hire the best talent you can afford. So instead of saying, well, I can get this junior person who doesn't know anything, but they got a great heart and their skill set would work here. Well, now you got to spend 2, 3, 4 years training them or ramping them up. And you can't really hand things off to them at the speed that you could if you hired somebody who already had a decade of experience. They cost twice as much, but they show up with a playbook. And they're like, hey, I've done this before. I've scaled a company just like this. I know more than you do. Here's the playbook. And then you could just give it all to them. Well, you think about, what are you really hiring somebody for? It's so that you can leverage your time. Well, if you hire somebody that's too junior, you haven't leveraged anything, because now you got to spend all your time teaching them. Eventually that works. It does work. But I think that's the discovery of, what's behind the message, hire the most talented person that you can afford. That's the reason for it.
That makes sense. Kind of switching gears, going back to our target audience, like I told you, is either new investors or people switching from residential to commercial. So me and Jesse have never done a mobile home park in our life. A lot of our audience probably hasn't either. What would you, like, if you could say, go out to buy your first deal, this is what you should look for. It should be, whatever it is, 10 units or 20 units, or it should be in the city, out of the city. Give me a picture of what somebody should go out and hunt for on their first deal.
First of all, it's hard for me to say that I would recommend a 10-space deal, because what I realized really quickly when we were buying mobile home parks is you don't gain economies of scale until you get about 50 units. So to hire a decent quality manager with some experience, you need about 50 units before the payroll can even be spread far enough to where it's affordable. So otherwise you're doing it yourself. So I don't think that there's a specific size, but if I was to tell my former self what size park should you start with, it would be at least 50 lots. I think that the advice that I would give to anybody who's getting into mobile home parks, but this would be true for any asset class, go underwrite 100 deals first. Don't buy anything. Go underwrite 100 deals. Now you could get 100 deals by just going on LoopNet or whatever Crexy or whatever platform you want to go on, and just type in mobile home park as your setting, and then just start looking at mobile home parks all over the United States. Don't worry about where they are. There is nuance in every asset class, but there's a lot of nuance in mobile home parks that you have to be able to get really familiar with. I can sniff test a deal in about 20 minutes. My business partner does extremely complex financial modeling. He can do that in about 2 hours. If a deal gets past the sniff test, then he does that, right? And that's getting down into the weeds with respect to percentage of property tax growth, in a specific market that requires research to discover what's going to happen, right? But there's so much nuance. If you just go buy a mobile home park, you're probably going to learn a ton of great lessons, and it's going to be expensive, and it might not be as profitable as you thought it was going to be. That's why I recommend the best education is free. It's just time. Go underwrite 100 of them. And if you look at enough of them, you'll start to recognize things. In my opinion, buying something that's listed publicly for sale is probably not going to be a good deal. I've not ever purchased a mobile home park that was publicly listed for sale. Everything is done off market. So in your backyard, there's an owner who owns a mobile home park, and he's not thinking about selling. But if you go have coffee with him, and you have coffee with him again, and you have coffee with him again, he'll probably sell. I mean, that's just how things go, right? When it boils down, it comes down to this. People love doing business with people they like.
Yeah.
You might be a really likable person. They don't know you. Prove it. They'll sell to you.
Yeah. That's such a good point and so true.
Yeah.
It's like, it's about relationship building.
Yeah.
Like how good of a relationship can you build with somebody and how quickly? And, a lot of times it's not like just for gain. It's not just, I'm trying to build a relationship with this person only to get their property. Like a lot of times you actually end up learning a lot from those people. If it's an older investor, they can give you advice. And what we found is a lot of these older guys, they want to mentor somebody and give advice to somebody. And they like seeing younger guys who are hustling or getting after it. So, if somebody's newer and they go out there and ask for somebody's time to go to coffee, they like to see you asking questions about real estate. Mm-hmm. And then more importantly, they like to see you follow up with them, showing them, oh, we actually did something with the advice. I think what people don't like is when you ask them for a bunch of advice and then a couple months later, you're like, hey, did you do anything? And they're like, no, I didn't take any of your advice 100%. And I just sat there and did nothing with it.
Yeah. And that's a great point, Graham. I think to add on top of that is sometimes you build a friendship. You'd be surprised that what that turns into. Like it could end up being a mentor for you. So ultimately, I think the difficult thing for a lot of these legacy mobile home park owners, and it's probably a little bit more unique in the mobile home park business than I've found in other asset classes. They built the park in 1971. They built it, or their dad built it, and then their dad handed it down to them. So this is kind of like a family treasure in their mind. And they know all the tenants, and those tenants have been there for 40 years, and they know them all. And so the thought of having some stranger come in there and take over doesn't allow them to sleep good at night. So there's a dynamic in the mobile home park space, and this is probably why, Graham, that you spoke to. It's common that you can get seller financing. It's also common that assets trade off market. There's plenty of parks that get listed publicly for sale, but there's a lot of transactions that take place that you would never know. And it's because of that thing. So put yourself in the shoes of, my dad built this park. I grew up in this park. I was the maintenance guy for like 20 years, and now I'm the owner and I run it. And Dad's passed away, and I'm 70 years old, and I'm not selling this thing. I love these people, and this is my life, right? They're not going to call a broker. Well, first of all, brokers are calling them. Trust me, brokers are calling them every day, and they're saying, I can sell your park for XYZ dollars. So they know what it's worth. They don't want to put it for sale because they're never going to know who the buyer is. Now you go knock on that guy's door and you sit down with them and say, hey, I would love to get into this business, love to learn from you, and I'd actually love to be a buyer of your park. He gets to know you and he starts to think in terms of, hey, I don't have a son that I can hand this off to, but this person I'm starting to like and trust. And I actually think he would be a good steward of this to kind of carry on the legacy that our family built. And I think he would be a good manager, and he would take care of these people that live here that I really like and I have a relationship with. Now that door opens, and prior to that, it probably wasn't open. So that's probably a little bit more unique in the mobile home park business than it is in other asset classes, but that dynamic is absolutely there.
Yeah, it makes a ton of sense too. And I think on the same note of this is if you're looking for, if you're in an area, let's say you're in Arizona and you find a deal that you want to buy, but you don't know how to take it down. It's your first deal, you're pretty nervous about it. Partner with somebody like Jack that has done a bunch of these and can tell you, all right, this actually is a good deal. I'll take it down with you. And if you can partner in that way, that's a great way for you to get involved in your first deal as well. We've done that with industrial deals, and we talk about this quite often. We call it bird dogging, but is that something that you would be open to, Jack, if someone brought you a deal?
Yeah, it would. Well, I would, but it would have to be a pretty big deal. So like I said at the beginning of the show, the likelihood of somebody that's brand new landing a $20 million deal is probably pretty low. But yeah, if they brought me a sizable $20 million asset, we could do something. I've seen it happen the other way around too, Jesse. We've had people invest with us, write a $100,000 check. They just want to gain exposure and they want to see how a professional operator does it.
Yeah.
And then because they have my ear and they're one of my investors, they, hey Jack, let's go to coffee. I'm looking at this deal. I want to analyze it with you or whatever, right? So it works both ways. I think that the message here is when you give, you'll probably be open to receiving as well. I believe in the law of reciprocity that, giving doesn't necessarily mean that the person you're giving to is where you can expect to receive. But the more you give, the more life gives back. You do good things will probably happen to you. So it's a lot of that is just about having a good heart.
I like that. Yeah. Well, Graham, did you have any more questions for Jack?
No, we covered a ton.
Yeah. I think too, like a lot of the principles that Jack's talking about, it's not just for mobile home parks too. It's for a lot of these industries. I think a lot of times you get in front of a mom and pop owner, whether it's self-storage, boutique hotels, anything in that area. And you show them you're just a person and that you like this asset. And, it's different, when brokers are calling all the time and say, hey, I can sell your property, and as opposed to, hey, I want to buy your property and I'm willing to have coffee with you. I'm willing to take time. Like, I think that's just a really great principle that you can take to any asset class, even if you're not interested in mobile home parks. But it's been a really cool understanding mobile home parks on a deeper level, and I really appreciate your time, Jack. If people want to contact you or want to invest with you, how can they reach out to you?
Go to our website, 5210.com, and that's the number 52 and then TEN, so 10 is spelled out. Jump on the contact page and then you'll be able to get right on my calendar.
Awesome. Well, I appreciate your time, and we'll catch you guys in the next episode. Thanks.
Yep.
Thanks
so
guys.
much.